What does tax favorable tax treatment of life insurance encourage people to do? By the end of this video episode, you will understand that because of tax favorable treatment of life insurance, it encourages people to save totally tax-free for retirement. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for north of 48 years. Doing what? Helping people optimize their assets, minimize taxes, and empower what I call their authentic wealth. Most people come to me through the financial dimension or portal because they want to increase the liquidity, the safety, the rate of return, and the tax benefits on where they're setting aside their serious cash, money that they do not want to jeopardize or lose. This is usually money that is earmarked for their retirement or maybe college funding for their kids or grandkids or working capital they have to have on hand and liquid for their business or for real estate management in case their apartments go vacant or need to be refurbished or whatever. They want to be able to have a solution where they can have their money that's accessible, that's liquid. They can get it when they need it without triggering an IRS penalty or triggering tax. They want it to grow at a decent rate of return because having money in a bank or a credit union earning less than 1% is pathetic. This is why they come to us, to be able to optimize those assets and minimize taxes and be able to structure an account that's very, very flexible to be used for all kinds of goals. But at the end of the day, a lot of people come to us primarily for living benefits like retirement income because a properly structured, maximum funded IUL policy, generally speaking, will knock the socks off of most traditional IRAs or 401ks, where most Americans save money for retirement. And I can prove that all day long. There's a lot of episodes on this channel that address that. But I'm going to focus on the question I started out with. What does favorable tax treatment of life insurance really encourage people to do? When I begin to educate people and even professionals like CPAs and tax attorneys, oftentimes I'll have a room full of 80 CPAs or tax attorneys, and all of a sudden they sit there with their mouths open and they go, Doug, I've heard about these sections of the code. I've heard about these, but you know what? I've never really checked into it because I didn't need to understand this in order to pass the accounting exam to become a CPA. I did not need to know this to get an LLM degree, which is a master's in taxation, which I think is pretty ridiculous. But now they're wanting to learn advanced continuing education, and they're like blown away. And they realize they've been advising a lot of their clients wrong. They think it's wrong. And I say, well, no, telling your client to put money in IRAs or 401ks or whatever isn't, the worst advice. It's not the best advice, but it's not the worst advice. But now you know better. Okay. So there's only one vehicle, I teach them, in the Internal Revenue Code. And by the way, people, I have critics that go, oh, really? There's only one vehicle that does this? And I go, show me any other vehicle that does this in the Internal Revenue Code. Does what? Accumulate your money totally income tax free. Well, there's a lot of vehicles that do that, or tax deferred is what most of those are, but not totally tax free. Number two, then allows you to access that money at any time, even 4 days after you put money in, or you don't have to wait till you're 59 and a half. You can put in money and 4 months later, you put in 200,000, you can go grab 100,000 of it and not have a 10% penalty or trigger tax. And so you can access that money totally tax-free and penalty-free, and if you do it correctly. And then at the end of the day, when you finally die, because none of us are getting out of here alive, out of this life. When we die, it actually blossoms. It usually increases in value and transfers totally income tax free to your heirs, your beneficiaries. Nothing else does that. Municipal bonds don't do that. Roths don't do that. And I've yet to have anybody show me what does that. And so even though they go, oh, really? Nothing else does that? I go, yeah, show me. Show me anything else that does that. Accumulate your money tax-free, allows you to access the money tax-free, and then when you die, it blossoms and transfers tax-free. Now, if you don't know what I mean by blossom, I'll just say it this way. I'm going to be 70 here in a couple of months, and if I died in an accident, every million I might have in a portfolio of IUL policies, laser funds. A laser fund is a properly structured, max-funded indexed universal life. Most IUL policies would not qualify to be deemed a laser fund, which is another topic you can learn about on this channel. But every million that I might have would blossom to over 2 million and transfer tax-free to my wife, my kids, my grandkids if I die at a church or charity, whoever I want to leave it to, in the form of a tax-free death benefit. Nothing else does that. So that's what I mean by accumulate, access, and transfer your money totally tax-free under 3 sections of the code that in one form or another have been around now for more than 108 years. And you have to comply with 3 tax citations, TEFRA, DEFRA, and TAMRA. Those are acronyms. They stand for the Tax Equity Fiscal Responsibility Act of 1982, the Deficit Reduction Act of 1984, and the Technical and Miscellaneous Revenue Act of 1988. That tells you the minimum amount of insurance that must be attached to the account. You're taking the least amount of insurance you can get away with to be able to put in the most money the IRS will allow as fast as they allow, which is dictated by TEFRA, DEFRA, and TAMRA. Because your primary objective is living benefits more than death benefit. You want the least amount of insurance the IRS will let you get away with and put in the most money the IRS allows as fast as they allow. And it turns into this tax-free cash cow used for living benefits, okay? So when people begin to really learn this and they understand it, they go, hello, this is a no-brainer. So when they learn of the tax-favored treatment of properly structured indexed universal life, where I've been able to earn within 1 percentage point of the gross rate of return for years at the end of the day, if I earn 11, I net 10. If I earn 6, I net 5. If I earn 16, I net 15. There's years like 2020 to 2021, many clients earned 61.33 and netted 60%. Yep. Using max-funded indexed universal life. When you understand the tax-favored treatment, what does that encourage you to do? People go, hello, can I take money out of a bank or a credit union that's only earning 1% and it's taxable and put it in here? Yep. Hey, I'm tired of being a landlord. I have this rental property. I just want to sell it. I don't want to take out the trash anymore and fix these toilets and evict tenants. Can I just sell and put the money into one of these? Yes. I have money trapped in IRAs or 401ks, and I've now learned it's not saving me by deferring till I'm 72 and taking out RMDs. I'm actually compounding the tax. Yup. And I show them the math, and they go, this is stupid. Can I reposition? Can I roll the money out? Notice I said roll out. It's not a rollover. A rollover is going from the frying pan into the fire. That's taking money out of a 401k and rolling it over to an IRA and continuing to defer. No. You do a strategic rollout. Can I roll, 200,000, 500,000, $1 million out of my IRAs or 401k strategically over, let's say, a 5-year period and put it into max-funded IUL so it's tax-free from this point forward. And when I ultimately die, all the taxes I did pay are reimbursed to my family because of the tax-free blossoming when I die. Yep, you're getting it. When people get it, it encourages them to then set aside money, save money a smarter way. By doing that, they reposition underperforming or non-performing assets into max-funded IUL policies. Does that make sense? And so you do that when you understand how to accumulate, access, and transfer money totally income tax-free. And this is why people get encouraged to use these and take ownership for their future, which takes pressure off of the government to have to provide for you. So if you outlive your money in traditional IRAs or 401ks, no, you won't have to be a drain on society. And if you die and leave behind widows and orphans, they will not be a drain on social dollars because you took care of them. That's why it's tax-free. And if the government taxed those, they would be shooting themselves in the foot. And so far, they've been smart enough to leave these alone. I can't guarantee that because sometimes Congress does stupid things when they get greedy for tax revenue. But so far, so good. There have been times, like in 1990, they studied, should we tax these? And they came to the conclusion, let's leave them alone. It would cost us more than it would make us. In the short run, we might make tax revenue. In the long run, it's going to cost us. So they've said, leave it alone. This is why I'm so passionate about max-funded IUL, because when you structure one correctly and fund it properly, it is now a laser fund. It's a liquid asset safely earning returns. If you want to read about this, I want to gift you a copy of my most recent 300-page best-selling book called The Laser Fund, which is actually 2 books in one. This side is about 200 pages, 14 chapters, with all kinds of charts and graphs if you're a left brain learner. If you're a right brain learner, you learn by stories. You flip it over and read this one. This is about 100 pages, 12 chapters with 62 actual client stories. If you want to learn with both your left brain and right brain, you can read both, okay? But you simply claim your free copy by going to laserfund.com, L-A-S-E-R fund.com, or click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, but you've got to have some skin in the game. I will pay for the book. I'll send out a hard copy. There's options there to listen and learn, watch and learn. You can even check out some of the online educational webinars. You even have the opportunity to talk to an IUL professional that I have mentored to see how this may apply in your particular circumstances at absolutely no cost or obligation. This is about you and your brighter future.